The moment your paycheck hits your bank account, it stops being yours. That's not a metaphor. It's not a conspiracy line. It's a legal reality most people never hear out loud. You tap your phone, balance updated, rent covered, groceries safe, life continues. But behind that clean number on your screen, something fundamental has changed. Your money has crossed a line. And on the other side of that line, ownership works very differently than most people imagine. This matters right now because more money is sitting in banks than ever before. Digital balances, auto deposits, invisible cash. And at the same time, banks are under more pressure than they've been in decades. Interest rates whiplashed, liquidity dried up, a few quiet failures, a few emergency rescues. And suddenly, a question that used to sound theoretical doesn't feel so academic anymore. When you deposit money in a bank, what do you think is happening? Most people picture a vault, a box with their name on it, their cash waiting patiently until they come back for it. That image is comforting. It's also wrong. Let's rewind to a normal Tuesday. You deposit $10,000. Could be years of savings, could be a bonus, could be everything you have. The app says available balance. You feel secure. But legally, you did not store money. You made a loan. The moment your money hits the bank, it becomes the bank's money. In exchange, the bank gives you something else, a promise. That promise says, if you ask for your money back, under normal conditions, the bank will give you the same amount. Not the same bills, not the same dollars, just the number. You are no longer the owner of that money. You are a creditor. This isn't new. This isn't a loophole. This has been the core design of modern banking for hundreds of years. Banks don't work by guarding money. They work by using it. Your deposit is raw material. Here's where the story gets uncomfortable. Banks don't keep your money sitting idle. They can't. If they did, the system would collapse under its own weight. Instead, they lend most of it out. Your money becomes someone else's mortgage, someone else's car loan, someone else's business expansion. One deposit quietly supports multiple financial lives at the same time. This is called fractional reserve banking, but the name makes it sound technical and distant. The reality is simpler. For every $100 you deposit, the bank might keep 10, sometimes less. The rest is sent back out into the economy, earning interest. That interest is how banks survive. And this works beautifully until it doesn't, because your money isn't gone in a dramatic way. It's spread out, thinly, quietly, across thousands of bets the bank is making every single day. Most days nobody notices. Withdrawals are predictable. Cash flows in, cash flows out. The machine hums. But now imagine a moment when too many people ask the same question at the same time. Can I have my money back? If everyone asked it once, the answer would be no. Not because the bank is evil, not because it's stealing, but because the system was never designed for that scenario. Your balance is real, but the cash behind it is conditional. This is where hype and reality split. The hype says your money is safe because banks are regulated, because deposits are insured, because the system is strong. The reality is more nuanced. Deposit insurance does not mean your money is sitting untouched. It means there is a backup promise if the first promise fails. And even that promise has limits. Insurance caps exist. Delays exist. Legal processes exist. Access is not instant. It's negotiated. In a bank failure, you don't reclaim your money like you retrieve a lost wallet. You stand in line as a creditor and wait for the system to decide how and when you're made whole. Most of the time, this works. That's the part nobody likes to emphasize because it's boring. The system survives because confidence survives. But confidence is a fragile thing. Banks don't collapse when they run out of money. They collapse when people realize how the money actually works. There's a quiet irony here. The safer a bank feels, the more money flows in. The The more money flows in, the more aggressively it can lend. The thinner its margin for error becomes. Safety creates risk, and risk hides until stress arrives. We've seen this movie before, not in dramatic explosions, but in slow realizations. A bank announces a liquidity issue. A government announces a temporary facility. Words soften the moment, but the mechanics underneath stay the same. Your deposit is a claim, not a container. Zoom out, and this design tells us something bigger about the entire money system. Money today is not a thing you hold, it's a relationship you trust. Your bank balance is a number backed by confidence, regulation, and collective belief that tomorrow will look mostly like today. That belief is incredibly powerful. It built global trade. It built modern economies. It also means stability depends on people not thinking too hard, too fast, all at once. This isn't an argument to panic. Panic is what breaks systems like this. It's an argument to understand the trade you're making. When you deposit money, you gain convenience, speed, digital life, access, yield. In exchange, you give up direct ownership. You become part of a system that only works because most people never test its edges. So the next time you check your balance, don't ask how much money you have. Ask a quieter question. If everyone wanted their money back tomorrow, whose money would it really be?